My name is Rachel Zargami. I'm counsel in our Stamford office of Cummings Lockwood, and I've been asked to speak to you today about estate planning in the era of portability and higher exemption amounts. Just to reframe this discussion, there have always been tax and non-tax reasons to do estate planning. The non-tax reasons are just as alive as they ever have been, but clients often come to us very tax motivated. That's kind of the first thing on the forefront of their minds. They hear they can save 50 cents on the dollar by doing some tax planning, and these new developments may have changed their appetite for coming in to do their planning. And they may come to you with these questions. They read in the Wall Street Journal about portability, and you no longer have to do tax planning. And so we're going to dispel some of those rumors and let you know exactly what they can count on. Let's quickly look at the new estate tax exemptions. This year, for the next 4 weeks, we have a $5.49 million federal estate tax exemption. That's $10.98 million per couple. State estate tax exemptions, where there is a state estate tax, they differ. Connecticut is $2 million flat this year. New York is $5.25 million. Next year, they increase on the federal level and in Connecticut, but not in New York. We have $5.6 million, as Laura was telling you, on January 1, or $11.2 million per couple. So as Meg mentioned, very few estates are taxable for federal estate tax purposes. It used to be about 2% nationwide, and now it's 0.2% nationwide. I think a lot of those estates are right in this county, and so you probably work on some of those clients, but a lot fewer of our clients are subject to estate taxes now. You can see the map of where the state estate taxes and inheritance taxes are. The yellow up on the screen have a state estate tax. And I don't know if you can see that clearly, but the tax rates range to about 20% for state estate taxes, and the exemptions vary from about $675,000 to $5.5 million. Right now, this is 14 states that have a state estate tax, plus DC. We lose 2 of those next year. Delaware and New Jersey are no longer going to have state estate taxes. And there are also 6 states that have an inheritance tax, which is a separate type of tax payable at death. Looking at a historical perspective, some of you guys have been in practice this long, but many of you haven't. So let's look at what it used to look like. There used to be a federal estate tax exemption 20 years ago of $600,000 per person. So, and a tax rate of 55% over that exemption amount. So a huge amount of tax was levied. But up until 2005, the federal government shared its tax rate with the states in a dollar for dollar credit. So what happened was, of the 55%, about 15% was paid to the states, and the federal government kept 40%. Because of the 2001 Tax Act, that was phased out. And so now you can see that the federal estate tax rate dropped, but actually it got a higher percent of those taxes, 100% of the tax starting in 2005. So some of the states, as I just told you, about 21, had to enact their own estate tax to cover the discrepancy in their budget. And that's why when states' fiscal economy started to plummet is when we stopped sharing some of the tax revenue with the federal government. So you can see that if you look at the combined federal and Connecticut estate tax, it's roughly the same as it was before, but the exemptions have gone up significantly. So portability, I'm sure you understand it in concept. I'll show you a little bit about the mechanics of it, is that it's a concept of the 2010 Tax Act. It's a deceased spousal unused exclusion amount. And we love acronyms as trust and estates lawyers, so we call this DSUE amount. And basically, if you don't use your exemption at death, meaning property passes in a way that it subjects it to federal estate tax, and we have an unlimited marital deduction, unlimited charitable deduction, but if you pass money to your children or to a trust for your family that doesn't qualify for a deduction, you used to lose your exemption. So it used to be a use it or lose it, and so that's why we came up with the bypass or the AB trust planning you're probably familiar with, to use the exemption at the first death so you didn't lose it. So now as a result of portability, instead of using it at the first death, you can give it to your surviving spouse. And the way you do that is you have to file a federal estate tax return. So it's an interesting conundrum now where you have to decide for, let's say, $1 million estate where you don't have to file an estate tax return. Do you want to do so exclusively to elect portability, to give remaining exemption to the surviving spouse? So I'll show you where you would see it, and if you want to help your clients understand it. On the first page of the 706, you'll see up on the screen, halfway down the page, there's a little entry I wrote where it says amount received. This would be a normal spouse's annual unified credit amount plus an amount received from a previously deceased spouse. On page 4 of that spouse's estate tax return, Section 6C is where you would declare how much extra exemption you're giving to the surviving spouse. So if the first spouse dies with a $1 million estate and that estate passes to a trust that doesn't qualify for any exemptions, they have another $4.49 million that they can give to their surviving spouse. The way they would do it is right here on page 4, and that would tie into the surviving spouse's return. There are some problems with relying on that, deciding that this is going to be your exclusive estate planning tool. Firstly, GST exemption is not portable, and that's an equally onerous 40% estate tax. It matches the federal estate tax, and it's a tax on transfers to 2 or more generations. It often catches trusts at the death of the beneficiary in the generation below the decedent. States don't allow portability. All but Hawaii do not allow their exemptions to be portable. So in Connecticut and New York, other states with a state estate tax, it is still use it or lose it at the first death. You don't get to shelter appreciation. This is a little nuance, but you only get to take the exemption of your most previously deceased spouse. So if you have somebody who's been widowed twice, the first spouse's disui amount is forfeited, and instead you only look at the most recently deceased spouse's amount. And laws change. We as trust and estates lawyers are nervous about new features of federal tax law, but now that it's been 7 years, maybe this is around to stay. But we hate to rely on things. We like to grab exemptions when they're available and shelter them, lock them away where they will escape estate tax for certain. You also lose creditor protection. If you give your exemption to your spouse, you may hope your spouse benefits the kids of your marriage, but you're not exactly sure. If you instead stick with the traditional planning of bypass trust, you know that trust will go to your children at your surviving spouse's death, regardless of how good that nurse is to your surviving spouse. You also need to carefully choose your executor, because it costs money to file an estate tax return and it subjects the estate to potential audit. The executor who's filing for the sole purpose of electing portability is only doing so really for the benefit of the surviving spouse. So if the beneficiaries are different, if the parents have children from different marriages, you can end up with an ugly situation where somebody doesn't want to give the unused credit to the surviving spouse, and the surviving spouse would very much like to have an extra exemption amount. So getting to the non-tax, but really important, always prevalent reasons to do estate planning, and I'm not gonna drill this down too much because you probably are familiar with most of these things, but just some of the notes and anecdotes from our practice. Our clients are living much longer than they ever have before, and we're seeing a lot more Alzheimer's and dementia in these later ages. And so you can do incapacity planning with a competent client. If you don't do estate planning with somebody who has capacity during their mental competency, you're basically inviting the probate or surrogates court in to appoint people of their choice. And it's expensive to have a conservator of the person appointed to make medical care decisions. It may not be a family member who's selected. The same for management of the client's assets. The court is going to oversee how every penny is spent. This is expensive and it's burdensome, and it often is not what a client would have wanted were they able to pick their own fiduciaries during lifetime. Property by intestacy, our legislature has done a great job trying to envision what someone would want if they didn't have a will. But essentially in New York and Connecticut, what they've said is, we're going to split the assets between the spouse and the kids. In Connecticut and New York, the spouse gets a sum certain. In Connecticut, it's $150,000, and the balance is split between the kids and the spouse. Your spouse may or may not be able to live on half of your assets for the rest of his or her life, but if you're concerned about that, you can write a will and say your spouse gets more or less than that. You can do third-party planning, what Dan was talking about with the Domestic Asset Protection Trust, where it's much more difficult to put money in a trust for yourself and keep it safe from your creditors. You can easily do this for a third person, for your spouse or for your children. You can take their inheritance, put it in a trust, and if they get divorced, they won't lose those assets. And you and your clients have worked hard. You don't necessarily want the divorcing spouse of your child walking away with half. And that's what would happen in Connecticut in most cases. The incentive for children with their planning, I don't know many 22-year-olds that would do great things with $1 million landing in their checking account. So putting it in trust and structuring the use of those funds is appealing. So we're getting to the final couple of slides. This is our Cummings and Lockwood flowchart. You're probably familiar with this if you've worked with us before. The top line represents how assets are titled right now while both clients are alive. You have assets that would pass by husband's will. You have assets that would pass by contract if they're owned jointly with right of survivorship. At the survivor's death, at the first spouse's death, they immediately become 100% property of the surviving spouse. You have property that'll pass by the wife's will. In this case, it's Jane Doe in the middle box, top row. And then assets that pass by beneficiary designation, like IRAs and 401ks, those also don't pass by a will. The first dotted line is the death of the husband. Mortality risk says that often happens, that the husband predeceases, so we'll do that in this example. What we just still think is prudent planning is to take the amount, at least the amount that'll pass free of state and federal tax, and stick it in a bypass trust. That trust exempt from estate tax, people call it a credit trust. You know a couple things. One, that trust will pass to the children of the marriage at the surviving spouse's death. And two, that trust will not be subject to tax. So those are two certainties, and we think, what is the downside to doing that? There's not much. You can structure the trust, as the clients want, with as much access to the spouse as desirable. And then everything else will pass to the spouse, either in the form of a rollover IRA or by virtue of the terms of the will. And then the second level of planning would be to instead shelter also the entire GST exemption at the first death, thereby increasing the amount that's GST exempt for the children and therefore not subject to the 40% tax at the children's death. So this is kind of still the basic estate planning tools that we've been talking about forever and ever. And we still think it's prudent, and we're still recommending it, and we would much prefer clients to do this planning rather than to rely on portability. Thank you so much.